One law stood between America and financial catastrophe for 66 years. Not a complicated regulation, not a 1,000-page bill filled with loopholes. Just 37 pages that said, banks that hold your money can't gamble with it. Commercial banks take deposits and make loans. Investment banks trade securities and take risks. You can't be both. That law was called Glass-Steagall, passed in 1933 after the Great Depression destroyed 9,000 banks and wiped out $140 billion in depositor savings. For 66 years, America didn't have a single major banking crisis, not one. Banks failed occasionally, but the system stayed stable. Depositors kept their money, the economy kept growing. Then Wall Street wanted it gone. They spent $300 million on lobbying between 1998 and 1999, the most expensive legislative campaign in American history. They promised that removing Glass-Steagall would make banking safer through diversification, that separating commercial and investment banking was outdated for the modern economy, that America needed competitive banks that could match European megabanks. Congress repealed Glass-Steagall in November 1999. President Clinton signed it. Wall Street celebrated. And exactly 9 years later, the financial system collapsed in the worst crisis since the Great Depression. Bear Stearns collapsed, Lehman Brothers bankrupt. Merrill Lynch fire sold to Bank of America. AIG needed a $180 billion government bailout. Citigroup, the bank that had lobbied hardest for repeal, required $476 billion in government guarantees to survive. Total cost of the 2008 financial crisis, $22 trillion in lost wealth, 8.7 million jobs destroyed, 10 million foreclosures. The exact catastrophe Glass-Steagall was designed to prevent. But what nobody knows is how it actually happened. Not the economics, the politics. How a law that had protected America for 7 decades was systematically destroyed by the banks it regulated. How Wall Street bought Congress, captured regulators, and convinced America that the guardrails preventing disaster were actually holding back prosperity. This is the story of how one law died and took the American economy with it. Senator Elizabeth Warren keeps a framed photograph in her office. President Franklin D. Roosevelt, signing the Banking Act of 1933. The photo shows FDR surrounded by congressmen, including Virginia Senator Carter Glass and Alabama Representative Henry Steagall, the law's namesakes. Roosevelt is smiling. He'd just signed the most radical banking reform in American history, and he knew it would work. The Banking Act of 1933, popularly called Glass-Steagall, had one simple principle: separate commercial banking from investment banking. Banks that took deposits from ordinary Americans couldn't use that money to speculate in securities markets. Investment banks that underwrote stocks and bonds couldn't take deposits. This separation existed because Roosevelt and Congress understood something Wall Street wanted everyone to forget. When banks gamble with depositors' money, taxpayers always pay the bill. Between 1929 and 1933, over 9,000 American banks had failed. Depositors lost $140 billion, roughly $2.8 trillion today. The failures weren't caused by bad loans to farmers or businesses. They were caused by banks speculating in the stock market with depositors' money, then collapsing when the market crashed. Glass-Steagall made that illegal. Commercial banks would be boring, safe, and regulated. They'd take deposits, make loans, and operate under strict oversight. Investment banks would be exciting, risky, and unregulated. They'd underwrite securities, trade stocks, and gamble with their own capital, not depositors' money. For 66 years, this system worked perfectly. America experienced enormous economic growth between 1933 and 1999. Banks financed the post-war economic boom, the interstate highway system, the suburban housing expansion, and the technology revolution. All without major banking crises. Sure, individual banks failed. In the 1980s, the savings and loan crisis destroyed about 1,000 thrifts, but commercial banks, protected by Glass-Steagall, remained stable. Depositors never lost money in FDIC-insured accounts. The banking system never faced systemic collapse. What most people don't know is that Wall Street had been trying to kill Glass-Steagall since 1934, literally 1 year after it passed. Banks hated the separation of commercial and investment banking. It limited their profits, constrained their growth, and prevented them from becoming financial conglomerates. Between 1935 and 1980, Wall Street lobbied Congress to repeal Glass-Steagall at least 17 times. Every attempt failed. The law was too popular. Americans remembered the Depression. They trusted Glass-Steagall to protect their savings. But in the 1980s, something changed. Ronald Reagan appointed pro-bank regulators who believed Glass-Steagall was outdated. Banking industry lobbyists convinced Congress that America needed bigger, more competitive banks. And Wall Street developed a new strategy. Don't repeal Glass-Steagall legislatively, just erode it through regulatory exemptions. By 1990, Glass-Steagall still existed on paper, but regulators had granted so many exceptions that the law was effectively dead. Banks were underwriting securities, trading derivatives, and mixing commercial and investment operations, all technically illegal under Glass-Steagall, but permitted by friendly regulators. The final repeal in 1999 wasn't really a repeal. It was an acknowledgement that regulators had already destroyed the law. Congress just made it official. Behind the repeal was a staggering amount of money. Between 1998 and 1999, the financial industry spent $300 million lobbying Congress, more than any industry had ever spent on a single legislative priority. They hired 2,250 lobbyists, including 73 former members of Congress. They donated $150 million to political campaigns. They funded think tanks, academic research, and media campaigns arguing that Glass-Steagall was obsolete. The lobbying effort was led by Citigroup, or more precisely by the illegal merger that created Citigroup in 1998. Citicorp, a commercial bank, merged with Travelers Group, an investment bank, and insurance conglomerate, creating a financial supermarket that violated Glass-Steagall. The merger was approved by regulators with a 2-year exemption to come into compliance with Glass-Steagall. Instead of complying, Citigroup spent those 2 years lobbying Congress to repeal the law. They succeeded. In November 1999, President Clinton signed the Gramm-Leach-Bliley Act, officially ending Glass-Steagall's separation of commercial and investment banking. Wall Street celebrated, bank stocks soared, CEOs predicted a new era of financial innovation and prosperity. Treasury Secretary Robert Rubin, who'd helped orchestrate the repeal, left government and immediately joined Citigroup's board, earning $126 million over the next decade. What nobody predicted was what came next. Between 1999 and 2008, American banks transformed from boring utilities into gambling operations. They used depositors' money to bet on subprime mortgages, complex derivatives, and securities backed by loans to people who couldn't afford them. When the bets failed, the entire system collapsed, and taxpayers paid $700 billion to bail out the banks that Glass-Steagall would have prevented from existing. Let me take you back to where it actually started. Not in 1999 when Glass-Steagall was repealed, but in 1929 when the stock market crashed and revealed how American banks had become gambling houses. October 24, 1929, Black Thursday, started like any trading day on Wall Street. At 10 a.m., the opening bell rang at the New York Stock Exchange. Traders expected a normal Thursday, maybe some volatility. The market had been shaky for weeks, but nobody predicted what would happen by noon. By 11 a.m., stock prices were in free fall. General Electric dropped 20 points in 2 hours. U.S. steel collapsed from $205 to $165. Panicked investors flooded brokerage houses demanding to sell. Phone lines jammed. Telegraph systems overloaded. Ticker tape machines ran 2 hours behind actual prices because trading volume was so extreme. By noon, the stock market had lost $14 billion, roughly $240 billion today. And the day wasn't over. Prices kept falling. At 1:30 p.m., leading bankers met at J.P. Morgan's office and pledged to buy stocks to stabilize the market. It worked briefly. Prices recovered slightly. By closing bell, the market had only lost $9 billion. Wall Street told America the crisis was over. The bankers had saved the market. Friday would be fine. It wasn't. The following Tuesday, Black Tuesday, October 29th, the market lost another $14 billion. Total losses in 5 days. over $30 billion, roughly $500 billion today. But the stock market crash wasn't the real problem. The real problem was how banks had funded the speculation. You see, 1920s America had discovered buying on margin, purchasing stocks with borrowed money. Investors would pay 10% down and borrow 90% from their bank. If the stock went up, they'd sell, repay the loan, and keep the profit. If the stock went down, they'd lose everything and still owe the bank. Banks loved margin lending. They'd loan money to investors at 12% interest who'd buy stocks that were rising 20–30% annually. The loans seemed risk-free. If borrowers couldn't pay, the bank would just seize the stock collateral. This worked brilliantly until stock prices stopped rising. Then the entire system collapsed like dominoes. When stock prices fell in October 1929, banks issued margin calls, demands that borrowers immediately repay loans or provide more collateral. Borrowers couldn't pay. They'd already lost their savings in the market crash. Banks seized their stock holdings and sold them, flooding the market with more shares and pushing prices down further. As prices fell, more margin calls went out. More stocks were sold. Prices fell further. The downward spiral was self-reinforcing and unstoppable. But here's what made it catastrophic. The banks lending money for stock speculation weren't investment banks. They were commercial banks, the same banks where ordinary Americans kept their savings accounts. National City Bank, now Citibank, was the worst offender. They'd created an investment subsidiary called National City Company that sold stocks and bonds to the public. When customers bought securities from National City Company, they'd often borrow the purchase money from National City Bank, the commercial banking side. This created a perverse incentive. National City Company would sell stocks to customers who'd borrow from National City Bank to buy them. If the stocks went up, everyone won. If they went down, National City Company kept its commission, but National City Bank lost the loan money, which came from depositors' savings. Between 1927 and 1929, National City Bank loaned over $1 billion for stock speculation, roughly $17 billion today. When the market crashed, those loans became worthless. The bank's depositors, ordinary Americans who'd never bought a stock, lost their savings because the bank had gambled their deposits on Wall Street. National City wasn't alone. Investigations later revealed that most major American banks had been using depositors' money for securities speculation. Chase National Bank, Bank of America, J.P. Morgan, all were running investment subsidiaries funded by commercial deposits. The statistics were staggering. In 1929, commercial banks held $49 billion in deposits, roughly $830 billion today. Of that, approximately $8 billion, over 16%, had been loaned out for stock market speculation. When the market collapsed, that $8 billion became uncollectible debt. Banks couldn't absorb those losses. They became insolvent. And when banks become insolvent, they close their doors and depositors lose everything. The first major bank failure was Bank of United States in December 1930. Despite its name, it was a private New York bank, not a government institution. It held $200 million in deposits, savings from 400,000 working-class New Yorkers. When the bank collapsed, those depositors lost everything, life savings gone, no deposit insurance existed. The Bank of United States failure triggered panic. If a bank that large could fail, any bank could fail. Depositors across America rushed to withdraw their savings. This created bank runs, when everyone tries to withdraw simultaneously, forcing banks to liquidate assets at fire sale prices to raise cash. Bank runs are self-fulfilling prophecies. Even healthy banks fail when subjected to runs because they can't convert all their assets to cash instantly. Banks operate on fractional reserve principles. They keep maybe 10% of deposits as cash and loan out the rest. If everyone wants their money simultaneously, it doesn't exist. Between 1930 and 1933, over 9,000 American banks failed. That's more than one-third of all banks in the country. Depositors lost $140 billion, roughly $2.8 trillion today. Families lost their homes. Businesses couldn't make payroll. The entire economy seized up because the banking system had collapsed, and it all traced back to one fundamental problem. Banks were gambling with depositors' money in the stock market. Congress investigated. Senator Carter Glass of Virginia, a conservative Democrat who'd spent 40 years in politics, led the inquiry. Glass was horrified by what he discovered. Banks weren't just making bad loans, they were deliberately defrauding depositors. The investigations revealed that National City Bank had sold worthless securities to its own depositors. The bank's investment subsidiary would create bonds backed by Latin American loans that executives knew would default. Then they'd sell those bonds to National City Bank's commercial customers, people who trusted the bank. When the bonds defaulted, depositors lost their money. But National City Company kept its underwriting fees, and National City Bank executives kept their bonuses, which were based on the volume of securities sold, not their quality. Charles Mitchell, National City's chairman, had earned $3.5 million between 1927 and 1929, roughly $60 million today, while leading the bank into insolvency. He'd paid himself massive bonuses while selling garbage securities to depositors who trusted him. The public was outraged. These weren't abstract financial failures. These were deliberate frauds committed by bankers who'd enriched themselves while destroying depositors' life savings. Glass and his congressional allies, particularly Alabama Representative Henry Steagall, began drafting legislation to prevent this from ever happening again. Their solution was radical and simple: separate commercial banking from investment banking completely. Commercial banks would take deposits and make loans. They'd be regulated, insured, and boring. Investment banks would underwrite securities and take risks. They'd be unregulated, uninsured, and exciting, but they couldn't be the same institution. Wall Street hated this idea. Separating commercial and investment banking would cut their profits dramatically. Banks made enormous money from underwriting securities and using depositors' money to fund those operations. Glass-Steagall would end that entire business model. But in 1933, Wall Street had no political power. They'd just destroyed the economy. Public opinion demanded radical action, and Franklin Roosevelt, inaugurated in March 1933 with the banking system in complete collapse, was ready to use that anger. Roosevelt understood something Wall Street never accepted. Banking is different from other industries. When a factory fails, it hurts workers and shareholders. When a bank fails, it destroys depositors' savings and crashes the economy. Banks require special rules because their failures create systemic damage. On March 9, 1933, 5 days after his inauguration, Roosevelt pushed the Emergency Banking Act through Congress in 7 hours. The law gave the president power to close insolvent banks, reorganize healthy ones, and prevent bank runs through federal guarantees. But the Emergency Banking Act was temporary. Roosevelt needed permanent reform, and Carter Glass had it ready, the Banking Act of 1933, which would soon be known as Glass-Steagall. The battle over Glass-Steagall would define American banking for the next 66 years, and it started with the most dramatic confrontation between government and Wall Street in American history. The Banking Act of 1933 was introduced in Congress on May 10, 1933. It was 37 pages long. The key provision, Section 16, prohibited commercial banks from underwriting or dealing in securities except for government bonds. Section 21 prohibited securities firms from accepting deposits. Together, these sections created an absolute wall between commercial and investment banking. Banks would have 1 year to choose: remain a commercial bank and give up securities activities, or become an investment bank and give up deposit taking. No exceptions, no loopholes, no gradual transition. Choose. Wall Street's response was immediate fury. J.P. Morgan himself, the most powerful banker in America, testified before Congress against the bill. He argued that separating commercial and investment banking would make American banks uncompetitive with European banks that operated as universal financial institutions. Morgan's argument was sophisticated. European banks, particularly in Britain and Germany, combined commercial deposits, investment banking, and insurance under one roof. These universal banks could offer complete financial services to corporations. If America forced banks to specialize, American companies would turn to European banks for sophisticated financing. Senator Glass didn't care. "Mr. Morgan," he said during testimony, Your bank used depositors' money to speculate in the stock market, then sold worthless securities to those same depositors. You personally profited while they lost everything. I don't give a damn what European banks do. American banks will not be allowed to defraud American depositors. The exchange was explosive. Nobody talked to JP Morgan that way. He was American financial royalty. His bank had literally bailed out the US government multiple times. But Glass understood that 1933 wasn't 1907. Morgan's prestige meant nothing to Americans who'd lost their savings in bank failures Morgan's bank had contributed to. National City Bank tried a different approach. They commissioned economic studies arguing that separating commercial and investment banking would reduce credit availability and slow economic recovery. They hired prominent economists to testify that Glass-Steagall would make the Depression worse. Representative Steagall demolished this argument with a simple question to one economist. Did you work for National City Bank? The economist admitted he'd been paid $50,000, nearly $1 million today, for his independent research. Steagall then revealed that National City had paid for most of the studies opposing Glass-Steagall. The corruption was blatant. Wall Street was literally buying academic opinions and presenting them as objective analysis. Congress wasn't impressed. But Wall Street had one more card to play. They argued that Glass-Steagall would destroy jobs. If banks had to split their operations, thousands of employees would be fired. Communities dependent on banking employment would suffer. This was true but misleading. Yes, separating commercial and investment banking would require reorganization. Some jobs would be eliminated through consolidation. But the alternative, allowing banks to continue gambling with depositors' money, would eventually cause another crash that would destroy millions more jobs. Roosevelt made this argument directly to the American people in one of his fireside chats on June 12, 1933. He explained that banks had been speculating with other people's money and that such practices must stop. He promised that Glass-Steagall would protect depositors and prevent future banking crises. The public response was overwhelming support. Americans had lost faith in Wall Street. They wanted protection, not profits for bankers. Congressional offices were flooded with letters supporting Glass-Steagall. On June 16, 1933, Congress passed the Banking Act of 1933 by overwhelming margins, 262-19 in the House, 54-9 in the Senate. Roosevelt signed it the same day. Glass-Steagall was law. Wall Street had lost the most important legislative battle in banking history, and they'd lost badly. The law passed with huge bipartisan support despite spending millions on lobbying against it. The law's implementation was swift and brutal. Banks had until June 16, 1934, exactly 1 year, to comply. Commercial banks had to divest all securities operations. Investment banks had to return all deposits. No extensions, no exceptions. JP Morgan & Co. faced the most dramatic choice. They were simultaneously America's most powerful commercial bank and its most prestigious investment bank. Under Glass-Steagall, they had to pick one. JP Morgan chose commercial banking. They'd return deposits, make loans, and operate as a regulated commercial bank. But the partners who wanted to continue investment banking would have to leave and form a separate firm. In September 1935, several JP Morgan partners resigned and formed Morgan Stanley, a pure investment bank that would compete with their former partners. The split was amicable but symbolically powerful. The mighty House of Morgan, which had dominated American finance for 70 years, had been broken in half by Glass-Steagall. National City Bank made the opposite choice. They spun off National City Company as a separate investment bank and kept the commercial banking operations. The investment bank eventually became Lehman Brothers, while the commercial bank remained National City Bank, later renamed Citibank. By June 1934, every major American bank had complied with Glass-Steagall. The separation of commercial and investment banking was complete, and America's banking system had been fundamentally restructured. But Glass-Steagall did more than separate banking activities. It also created the Federal Deposit Insurance Corporation, FDIC, the government agency that would insure deposits up to $2,500, later raised. This meant depositors would never lose their savings in bank failures, eliminating the panic that caused bank runs. The FDIC was controversial. Many economists argued it created moral hazard. If deposits were insured, banks might take excessive risks knowing the government would bail out depositors. Glass and Steagall countered that the separation of commercial and investment banking prevented excessive risk-taking, so deposit insurance was safe. They were right. For the next 66 years, deposit insurance worked perfectly. Banks occasionally failed, but depositors never lost money. The FDIC paid claims from insurance premiums collected from banks. It never required taxpayer money until 2008. By 1935, Glass-Steagall had achieved something remarkable. It had restored public confidence in banking. Deposits started flowing back into banks. Credit became available again. The banking system stabilized, and the economy began its long recovery from the Depression. What most people don't realize is how popular Glass-Steagall was. Between 1933 and 1980, Congress never seriously considered repealing it. The law was considered sacrosanct, political suicide to oppose. Americans trusted that Glass-Steagall protected their savings. But Wall Street never accepted Glass-Steagall. From the moment it passed, banks began plotting to undermine, erode, and eventually destroy the law. They couldn't do it politically in the 1930s, 1940s, or 1950s. Americans remembered the Depression too vividly. But memories fade, and by the 1960s, a new generation of bankers, who'd never experienced the Depression, started arguing that Glass-Steagall was outdated and inefficient. The campaign to destroy Glass-Steagall would take 66 years, but Wall Street never stopped trying. Walter Wriston became CEO of First National City Bank, later Citibank, in 1967. He inherited a boring, profitable commercial bank constrained by Glass-Steagall. First National City took deposits, made loans, and earned steady returns. It was safe, regulated, and completely unexciting. Wriston hated it. Wriston believed Glass-Steagall was destroying American banking's competitiveness. European and Japanese banks were becoming financial conglomerates, offering everything from deposits to securities, underwriting to insurance. American banks were stuck in narrow specialties, unable to compete. He started lobbying Congress to repeal Glass-Steagall in 1968. His argument was sophisticated. Financial markets had changed since 1933. Computers enabled better risk management. Securities markets were more transparent. The dangers that existed in 1929 no longer applied. Congress ignored him. Glass-Steagall was still politically untouchable in 1968. The law had prevented banking crises for 35 years. Why change what was working? So Wriston tried a different strategy: regulatory arbitrage. If he couldn't change the law, he'd find loopholes in its enforcement. Glass-Steagall prohibited commercial banks from underwriting or dealing in securities, but it didn't clearly define those terms. Could a commercial bank offer investment advice without dealing in securities? Could they arrange securities transactions without underwriting them? Wriston decided to find out. In 1970, First National City created an investment advisory service that recommended stocks to wealthy clients. This didn't violate Glass-Steagall. Commercial banks could give advice. But Citibank also offered to execute those recommendations through partnerships with investment banks. The client would tell Citibank what to buy, Citibank would arrange the purchase, and an investment bank would technically execute the trade. Was this dealing in securities? Citibank argued no, they weren't actually buying or selling, just facilitating. Investment banks argued yes, Citibank was clearly engaging in securities activities prohibited by Glass-Steagall. The Federal Reserve, which regulated bank holding companies, had to decide. And in 1971 they ruled in Citibank's favor. The Fed said that arranging securities transactions wasn't the same as dealing in them. Citibank could continue their advisory business. This was the first crack in Glass-Steagall's wall. Wriston had found a loophole, and the Fed had blessed it. Now other banks rushed to copy Citibank's model. Between 1971 and 1975, dozens of commercial banks created investment advisory services that skirted Glass-Steagall's prohibitions. They weren't technically underwriting securities, but they were clearly engaged in securities-related activities that Glass-Steagall's authors had intended to prohibit. Investment banks screamed that commercial banks were violating Glass-Steagall, but the Fed kept granting exemptions and approvals. Why? Because by the 1970s, the Fed's leadership believed Glass-Steagall was outdated and needed to be relaxed. This was a crucial shift. Glass-Steagall was still law and Congress hadn't changed it, but the regulators enforcing the law had decided it was bad policy, so they simply stopped enforcing it strictly. In 1975, Citibank pushed further. They asked the Fed for permission to underwrite commercial paper, short-term corporate debt. Glass-Steagall clearly prohibited this. Commercial paper was a security. Underwriting it was exactly what Glass-Steagall banned. But Riston had a clever argument. Commercial paper was more like a loan than a security. Commercial banks made loans all the time. Why should short-term loans be treated differently than long-term ones just because they were called commercial paper? The Fed bought the argument. In 1977, they ruled that commercial banks could underwrite commercial paper up to certain limits. This was a direct violation of Glass-Steagall's text, but the Fed didn't care. They believed banks should have flexibility to compete. Investment banks sued, arguing the Fed had exceeded its authority. The case went to the Supreme Court in 1981. The court ruled 7-2 that the Fed had acted within its regulatory discretion. Glass-Steagall prohibited securities underwriting, but the Fed could interpret what counted as a security. This Supreme Court decision was catastrophic for Glass-Steagall. It meant regulators could redefine the law's terms to effectively eliminate its restrictions. Glass-Steagall still existed on paper, but regulators could interpret it into irrelevance. Between 1981 and 1987, the Fed approved hundreds of exemptions to Glass-Steagall. Commercial banks could underwrite municipal bonds. They could trade mortgage-backed securities. They could offer mutual funds. They could operate discount brokerage services. Each exemption was small. Each could be justified as not technically violating Glass-Steagall, but collectively they gutted the law. By 1987, commercial banks were engaged in almost every securities activity that Glass-Steagall had supposedly prohibited. Investment banks kept suing, but they were losing. Courts deferred to the Fed's expertise, and the Fed, now led by Alan Greenspan, a libertarian who believed financial regulation was harmful, kept approving exemptions. Greenspan explicitly believed Glass-Steagall should be repealed. In a 1987 speech, he argued that separating commercial and investment banking made sense in 1933 but is outdated in modern financial markets. He promised to use his regulatory authority to modernize banking rules. He delivered. Between 1987 and 1996, Greenspan's Fed approved exemptions allowing commercial banks to earn up to 25% of their revenue from securities activities. This made the separation of commercial and investment banking essentially meaningless. Banks could engage in substantial securities business while technically remaining commercial banks. The final regulatory assault came in 1996. Citibank asked the Fed for permission to acquire Lehman Brothers, one of Wall Street's largest investment banks. This would create a financial conglomerate combining commercial banking, investment banking, and insurance, exactly what Glass-Steagall prohibited. The Fed approved the acquisition. They ruled that Lehman Brothers would operate as a separate subsidiary of Citibank's holding company. Technically, the commercial bank and investment bank would be separate. In practice, they'd be under common ownership and management. This approval effectively killed Glass-Steagall. If commercial banks could own investment banks as subsidiaries, the separation was meaningless. Wall Street had won through regulatory erosion what they couldn't win through legislation. But Riston and his allies weren't satisfied. Regulatory exemptions were vulnerable. A new Fed chairman could reverse them. Congress could pass legislation restoring Glass-Steagall's restrictions. Wall Street wanted permanent repeal. And in the 1990s, they finally had the political power to get it. Between 1933 and 1973, America didn't have a single major banking crisis. Not one. Individual banks failed occasionally, maybe 10 to 15 per year. But these were small failures absorbed by the FDIC without systemic impact. Depositors never lost money. The banking system remained stable through World War II. the Korean War, multiple recessions, and enormous economic change. This wasn't luck. Glass-Steagall had fundamentally changed how banks operated. Commercial banks focused on boring, profitable activities, taking deposits, making loans, earning interest rate spreads. They couldn't speculate in securities markets, so they couldn't blow themselves up. Investment banks could still speculate, and they did. Securities firms failed regularly in the 1960s when trades went bad. But these failures didn't threaten the banking system because investment banks didn't hold deposits. When an investment bank failed, its investors lost money. When a commercial bank failed, depositors lost money. Glass-Steagall ensured only the former happened. The statistics are remarkable. Between 1933 and 1973, commercial bank failures averaged 13 per year, out of roughly 14,000 banks nationwide. That's a 0.09% annual failure rate, remarkably low by historical or international standards. And remember, these failures didn't cost depositors anything because of FDIC insurance. Compare that to the pre-Glass-Steagall era. Between 1920 and 1933, over 9,000 banks failed, nearly 70% of the total. Between 1933 and 1973, the exact same 40-year period, only 520 banks failed. Glass-Steagall reduced bank failures by 94%. The economic benefits were staggering. Stable banking enabled enormous economic growth. The U.S. economy expanded 450% in real terms between 1933 and 1973, and this growth happened without banking crises. Europe and Japan, which didn't have Glass-Steagall equivalents, experienced regular banking panics during this period. Britain had a banking crisis in 1957, Germany in 1966, Japan in 1965. Each crisis required government intervention, damaged the economy, and destroyed depositor confidence. America didn't have these problems. Glass-Steagall had created a banking system that was boring, stable, and exactly what a growing economy needed. What most people don't realize is how profitable commercial banking was under Glass-Steagall. Banks couldn't speculate in securities, but they didn't need to. The interest rate spread between deposits and loans was wide enough to generate excellent returns. Ronald Reagan appointed C. Todd Conover as Comptroller of the Currency in 1981. The Comptroller of the Currency regulates national banks, the largest commercial banks in America. Conover's appointment was a signal. Reagan wanted banking deregulation, and Conover would deliver it. Conover believed Glass-Steagall was the most harmful banking regulation in American history. He argued it prevented banks from competing globally, reduced efficiency, and limited consumer choice. In his 1983 testimony to Congress, he called for complete Glass-Steagall repeal. Congress refused. Glass-Steagall still had enough support to block legislative repeal. So Conover did what Walter Wriston had pioneered: regulatory erosion. He'd use his authority as comptroller to approve bank activities that technically violated Glass-Steagall. Between 1982 and 1985, Conover approved over 200 applications from commercial banks to engage in securities-related activities: municipal bond underwriting, mortgage-backed securities trading, private placements. Each approval came with carefully worded justifications about why the activity didn't technically violate Glass-Steagall. Investment banks sued every time, and they kept losing. Federal courts deferred to Conover's regulatory expertise. The comptroller said the activities were legal, so courts accepted that interpretation. But Conover's most consequential decision came in 1984, when he approved Bank America's acquisition of Charles Schwab, a discount brokerage firm. This merger combined a commercial bank with a securities firm, exactly what Glass-Steagall prohibited. Conover's justification was creative. Charles Schwab was a discount broker that just executed trades. They didn't provide investment advice or underwrite securities. Since they weren't doing the activities Glass-Steagall prohibited, their acquisition by a commercial bank was fine. This was sophistry. Glass-Steagall's purpose was to separate commercial banking from securities activities broadly, not just specific prohibited activities, but Conover didn't care about the law's purpose. He cared about enabling bank expansion. The Bank America-Schwab merger opened floodgates. Within 2 years, Dozens of commercial banks had acquired or created discount brokerage subsidiaries. By 1987, commercial banks controlled over 30% of the retail brokerage market, a market Glass-Steagall was supposed to exclude them from. Meanwhile, Alan Greenspan had become Federal Reserve Chairman in 1987. Like Conover, Greenspan believed Glass-Steagall should be repealed, but he was more sophisticated politically. Instead of attacking the law directly, he'd erode it gradually through exemptions that seemed reasonable individually. Greenspan's strategy was to redefine securities activities that Glass-Steagall prohibited. The law said commercial banks couldn't engage in underwriting or dealing in securities. Greenspan argued that modern financial instruments, derivatives, swaps, structured products, weren't really securities in the 1933 sense. This redefinition was radical. Of course, derivatives and swaps were securities. They were financial instruments whose value derived from underlying assets. But Greenspan classified them as risk management tools rather than securities, exempting them from Glass-Steagall restrictions. In 1989, the Fed approved J.P. Morgan's application to underwrite corporate bonds. This was a direct Glass-Steagall violation. Corporate bonds were unquestionably securities, and underwriting them was exactly what the law prohibited. But the Fed imposed a condition. J.P. Morgan's securities underwriting couldn't exceed 10% of total revenue. As long as securities remained a small part of their business, the Fed would allow it. This revenue limitation became the template for destroying Glass-Steagall. Between 1989 and 1996, the Fed gradually raised the revenue limit from 10% to 25%. At 25%, commercial banks could earn a quarter of their revenue from securities activities. The separation of commercial and investment banking was essentially over. Investment banks kept fighting, but they were losing political support. By the 1990s, many people in Congress and regulatory agencies believed Glass-Steagall was outdated. The economy had changed. Financial markets had globalized. American banks needed to compete with European and Japanese universal banks. The intellectual case for Glass-Steagall was collapsing, even though the law had worked perfectly for 60 years. Absence of banking crises was reinterpreted as evidence that the law was no longer necessary, rather than proof it was working. This is a common pattern in regulation. When rules work so well that people forget why they exist, support for the rules erodes. Glass-Steagall had prevented banking crises so successfully that people assumed banking crises wouldn't happen anymore. But some people remembered. Senator Paul Sarbanes of Maryland, a Democrat who'd studied the Depression, warned that eroding Glass-Steagall would eventually cause a financial crisis. In a 1994 Senate speech, he said, "We're removing the firewall between commercial and investment banking. We're allowing banks to gamble with depositors' money again. We're recreating the exact conditions that caused the Great Depression. This will end in catastrophe." Nobody listened. Sarbanes was dismissed as an old-fashioned populist who didn't understand modern finance. The financial industry spent millions on think tank studies and academic research arguing that Glass-Steagall repeal would make banking safer through diversification. One particularly influential study, funded by Citigroup, argued that combining commercial and investment banking would actually reduce risk because banks could diversify revenue streams. If securities underwriting declined, commercial lending would compensate. The study concluded that universal banking was safer than specialized banking. This was completely wrong, as 2008 would prove. But in the 1990s, it was treated as serious economic analysis. Congress cited the study in hearings. Regulators referenced it in rulemaking. The media reported it as objective research. Nobody mentioned that Citigroup had paid for the study. Nobody questioned whether the researchers might be biased. Nobody asked whether diversification might actually spread risk throughout the financial system rather than reducing it. By 1996, Glass-Steagall existed only on paper. Regulators had approved so many exemptions that commercial banks were deeply involved in securities activities. The separation of commercial and investment banking was effectively dead. But Wall Street wanted the law officially repealed. Regulatory exemptions could be reversed. A new administration might appoint regulators who'd enforce Glass-Steagall strictly. The only permanent solution was legislative repeal. And in 1998, Wall Street finally got the opportunity they'd been waiting for. April 6, 1998, Citigroup announced it would merge with Travelers Group. The merger was valued at $70 billion, the largest corporate merger in history at that time. It would create Citigroup, a financial services conglomerate offering commercial banking, investment banking, insurance and asset management under one roof. There was one problem. The merger violated Glass-Steagall. Citigroup was a commercial bank. Travelers owned Salomon Smith Barney, an investment bank. Combining them was explicitly illegal under Glass-Steagall's separation requirements. But Citigroup's executives, CEO Sandy Weil from Travelers and John Reed from Citigroup, had a plan. They'd announce the merger, apply for regulatory approval, and lobby Congress to repeal Glass-Steagall before regulators could block the deal. The Federal Reserve had to approve the merger because it involved a bank holding company. Under Glass-Steagall, the Fed should have rejected it immediately, but Fed Chairman Alan Greenspan supported the merger. He granted Citigroup a 2-year exemption to come into compliance with Glass-Steagall, meaning Citigroup had 2 years to either divest its investment banking operations or get Congress to repeal the law. This was regulatory blackmail. Greenspan was essentially telling Congress, "I'm approving this illegal merger. You have 2 years to change the law retroactively, or I'll force Citigroup to break up. Good luck." Wall Street understood the message. If they didn't get Glass-Steagall repealed within 2 years, the largest bank merger in history would collapse. Every financial institution that wanted to follow Citigroup's model had 2 years to make it happen. The lobbying campaign was immediate and overwhelming. The financial industry formed the Financial Services Coordinating Council, a coalition of banks, insurance companies, and securities firms, to lobby for Glass-Steagall repeal. They hired 2,250 lobbyists, including 73 former members of Congress. The numbers were staggering. Between April 1998 and November 1999, the financial industry spent $300 million on lobbying, more than any industry had ever spent on a single legislative priority. They donated $150 million to congressional campaigns. They funded academic research, think tank studies, and advertising campaigns. Citigroup alone spent $100 million. They hired every lobbying firm in Washington with connections to key committees. They brought congressmen to New York for educational briefings at luxury hotels. They promised campaign contributions to anyone who supported repeal. The lobbying campaign had 3 main arguments. First, Glass-Steagall was outdated for modern global finance. European and Japanese banks were universal banks operating in multiple business lines. American banks needed the same flexibility to compete globally. This argument was misleading. European universal banks had caused several financial crises in the 1970s and 1980s. But the lobbying materials ignored those failures and focused only on the successful universal banks. Second, combining commercial and investment banking would make banks safer through diversification. When one business line struggled, others would compensate. Universal banking reduced risk. This was exactly backwards. Combining risky investment banking with deposit-taking commercial banking spread risk throughout the entire financial system. But the lobbying materials included sophisticated economic models, proving diversification reduced risk. Third, repealing Glass-Steagall would benefit consumers through one-stop shopping for financial services. Customers could get mortgages, investment advice, and insurance from a single institution. This sounded good, but ignored a critical conflict of interest. Banks would pressure customers to buy proprietary products rather than recommending the best options. Glass-Steagall had prevented these conflicts by separating institutions. Congress received the lobbying onslaught while simultaneously hearing from constituents who supported Glass-Steagall. Consumer groups, labor unions, and community organizations opposed repeal. Polls showed most Americans wanted to keep Glass-Steagall. But Congress listened to the lobbyists, not the public. Why? Because the financial industry was writing massive campaign checks. Between 1998 and 2000, congressmen supporting Glass-Steagall repeal received an average of $300,000 in financial industry donations. Those opposing repeal received almost nothing. The bill repealing Glass-Steagall was written primarily by Citigroup lobbyists. Literally. Internal emails later revealed that Citigroup lawyers drafted key sections of the legislation, then gave it to friendly senators to introduce. The bill was called the Financial Services Modernization Act of 1999, sponsored by Texas Senator Phil Gramm, Republican, Virginia Representative Jim Leach, Republican, and Virginia Representative Thomas Bliley, Republican. It became known as the Gramm-Leach-Bliley Act. The bill's language was carefully crafted to sound reasonable. It didn't say repeal Glass-Steagall. That would have been too inflammatory. Instead, it said it was modernizing outdated Depression-era regulations to help American banks compete in the global economy. The marketing was brilliant. Who could oppose modernization and global competitiveness? The bill's opponents were framed as backward-looking protectionists trying to preserve antiquated rules. Senator Byron Dorgan, a North Dakota Democrat, saw through the spin. In floor debate, he said, "I think we will look back in 10 years' time and say we should not have done this. We will, in my judgment, someday regret this. We are setting up the American taxpayer to bail out banks that make bad decisions." Dorgan was prophetic. But in 1999, nobody wanted to hear warnings. The economy was booming. The stock market was soaring. Tech stocks were making millionaires. Everything felt great. Why worry about Depression-era banking rules? The congressional debate was remarkably short. The bill was introduced in February 1999, debated for 6 months, and passed in November. For legislation eliminating one of America's most important financial protections, the process was rushed. The House passed Gramm-Leach-Bliley 343-86. The Senate passed it 90-8. Both votes were overwhelming, bipartisan victories for the financial industry. Glass-Steagall was dead. President Bill Clinton signed the bill on November 12, 1999. At the signing ceremony, he said, "This legislation is truly historic. We are modernizing our financial services laws, tearing down these antiquated walls, and granting banks significant new authority." Clinton praised the bill for enabling one-stop shopping and helping American banks compete globally. He never mentioned the risks, never acknowledged that Glass-Steagall had prevented banking crises for 66 years, never considered that tearing down walls might expose Americans to catastrophic losses. At the ceremony stood Sandy Weill and John Reed from Citigroup smiling. They'd won. Their illegal merger was now legal, and every other bank in America could follow their model. Treasury Secretary Robert Rubin, who'd helped orchestrate the repeal, stood next to Clinton. Within weeks, Rubin would leave government and join Citigroup's board, eventually earning $126 million over the next decade. The revolving door between Wall Street and Washington had produced exactly the result Wall Street wanted, and the American people would pay the price. The Gramm-Leach-Bliley Act officially took effect on March 11, 2000. Wall Street celebrated like they'd won the World Series. Bank stocks soared. Citigroup's share price jumped 15% in the first week. Merger and acquisition activity exploded as banks rushed to create financial conglomerates. The consolidation was breathtaking. Between March 2000 and December 2001, over 400 bank mergers were announced. Commercial banks acquired investment banks. Investment banks acquired insurance companies. Everyone was building universal banking empires. J.P. Morgan merged with Chase Manhattan in 2000, creating J.P. Morgan Chase, a commercial bank, investment bank, and asset management firm combined. Bank of America acquired investment bank Montgomery Securities. Wells Fargo bought Wachovia. Deutsche Bank purchased Bankers Trust. Each merger created larger, more complex financial institutions that combined previously separate activities. Commercial banking operations, boring deposit-taking and lending, were mixed with investment banking operations, risky securities trading and underwriting. The financial industry argued this consolidation would make banking more efficient and competitive. Economies of scale would reduce costs. Universal banks could offer better service. American banks would dominate global finance. In reality, the consolidation created institutions that were too big to fail, too complex to manage, and too interconnected to rescue individually. But nobody wanted to hear warnings in 2000-2001. The economy was booming, banks were profitable, everything looked great. A few dissenting voices tried to sound alarms. FDIC Chairman Donna Tanouay warned in a 2000 speech that mixing commercial and investment banking could spread risk throughout the financial system in ways we don't fully understand. She was ignored. Brooksley Bourne, who'd chaired the Commodity Futures Trading Commission until 1999, had tried to regulate derivatives, complex financial instruments that would become central to the 2008 crisis. She'd been blocked by Treasury Secretary Rubin, Fed Chairman Greenspan, and SEC Chairman Arthur Levitt, who all argued derivatives didn't need regulation. Bourne warned that unregulated derivatives combined with Glass-Steagall repeal created catastrophic systemic risk. She was dismissed as an alarmist who didn't understand modern finance. What makes these dismissals particularly galling is that the people doing the dismissing, Rubin, Greenspan, Levitt, were wrong about everything. They promised Glass-Steagall repeal would make banking safer. It didn't. They promised derivatives didn't need regulation. They did. They promised the financial system could police itself. It couldn't. But in 2000, these men were treated as oracles. Greenspan was called the maestro for his management of the economy. Rubin was celebrated as the brilliant Treasury Secretary who delivered prosperity. Their assurances that everything was fine were taken as gospel. The media bought the narrative completely. Business publications ran glowing articles about the modernization of American banking. The Wall Street Journal published an editorial celebrating Glass-Steagall repeal as the final dismantling of Depression-era overregulation. Nobody asked critical questions. Nobody investigated whether the economic studies supporting repeal had been funded by banks. Nobody examined whether European universal banking was actually safer than American specialized banking. Nobody challenged the assumption that bigger banks were better. The few journalists who tried to investigate, like Byron Dorgan's staff economist, Jeff Connaughton, were stonewalled. Banks refused to provide data. Regulators claimed proprietary information couldn't be shared. Congress wasn't interested in oversight. Meanwhile, something dangerous was happening inside the newly merged universal banks: cultural contamination. Pre-repeal, commercial banks had conservative cultures focused on avoiding losses. Loan officers were trained to assess credit risk carefully. The mantra was protect depositors. Compensation was steady salaries with small bonuses. Investment banks had aggressive cultures focused on maximizing profits. Traders were trained to take calculated risks. The mantra was beat the market. Compensation was small salaries with massive bonuses tied to trading profits. When these cultures mixed after Glass-Steagall repeal, the investment banking culture dominated. Why? Because investment banking was more profitable. Securities trading generated higher returns on equity than boring commercial banking. Universal bank executives started pressuring commercial banking divisions to be more profitable like investment banking. This meant making riskier loans, charging higher fees, and cross-selling securities products to commercial banking customers. Loan officers who'd been trained to avoid risk were now incentivized to maximize volume. Their compensation shifted from salaries to commissions based on loan originations. Quality mattered less than quantity. This created terrible incentives. Loan officers would approve mortgages to unqualified borrowers because they'd get paid for originating the loan. When the loan defaulted, which might take years, the loan officer had already collected their commission and moved on. Investment banking divisions, meanwhile, were creating complex securities backed by these questionable loans. They'd bundle thousands of mortgages into mortgage-backed securities, MBS, and sell them to investors. The investment bank would collect underwriting fees, the commercial bank would earn origination fees, and both sides would profit. Who bore the risk? The investors who bought the mortgage-backed securities, and ultimately taxpayers, when the whole system collapsed. This risk transfer was exactly what Glass-Steagall had been designed to prevent. When commercial and investment banking were separate, each bore the consequences of their decisions. Commercial banks kept loans on their books, so they carefully assessed credit quality. Investment banks traded securities with their own capital, so they managed risk carefully. But universal banks could originate bad loans, package them into securities, sell them to investors, and collect fees at every step without bearing ultimate risk. This was a recipe for disaster. Some bank executives saw the danger. In 2003, J.P. Morgan Chase's Risk Management Committee warned that the bank was originating too many subprime mortgages, loans to borrowers with poor credit. The committee recommended reducing subprime exposure. Senior management overruled them. Subprime mortgages were too profitable to stop. J.P. Morgan continued originating billions in subprime loans, packaging them into securities, and selling them worldwide. Bank of America's story was similar. Their risk managers flagged problems with stated income loans, mortgages where borrowers didn't have to prove their income. These liar loans were obviously risky, but they were also profitable. Senior management prioritized profits over risk management. This pattern repeated across every major universal bank. Risk managers would identify problems. Senior management would overrule them. Profits were too good to stop, and the profits were spectacular. Between 2000 and 2006, universal banks earned record profits. Return on equity averaged 20 to 25%, far higher than the 10 to 12% that commercial banks had earned under Glass-Steagall. Executives were paid accordingly. Bank CEOs earned $20–40 million annually. Senior traders earned $5 to $10 million. Even mid-level employees received million-dollar bonuses. These compensation levels created perverse incentives. Executives optimized for short-term profits that maximized their bonuses, even if it created long-term risks. Traders made bets that would pay off within the year, long enough to collect their bonus, short enough that they wouldn't bear consequences if bets failed later. By 2006, the universal banking model created by Glass-Steagall repeal had generated $7 trillion in mortgage-backed securities, $3 trillion in collateralized debt obligations, derivatives of mortgage securities, $62 trillion in credit default swaps, insurance against security defaults, leverage ratios exceeding 30.1 at major investment banks. The entire financial system had become a leveraged bet on housing prices, continuing to rise forever. When housing prices fell, which they inevitably would, the system would collapse. And Glass-Steagall, the law that could have prevented this catastrophe, was dead. Between 2000 and 2007, American banks underwent the most dramatic transformation in their history. Commercial banks that had spent 70 years making boring loans suddenly became securities trading operations. Investment banks that had limited themselves to underwriting stocks and bonds suddenly had access to trillions in commercial deposits. The result was an explosion in risk-taking, unlike anything America had seen since the 1920s. Citigroup, the bank whose illegal merger had forced Glass-Steagall repeal, led the transformation. In 2000, Citigroup was a $700 billion institution earning $10 billion annually. By 2006, it was a $2.2 trillion institution earning $25 billion. How did Citigroup grow so fast? They used commercial bank deposits to fund investment bank securities trading. Depositors' savings, insured by the FDIC and backed by taxpayers, became gambling capital for proprietary trading desks. Citigroup's trading division would borrow from the commercial banking division at low interest rates, then use that money to buy mortgage-backed securities, collateralized debt obligations, and other complex instruments that paid higher returns. The spread between borrowing costs and investment returns generated enormous profits. But this strategy created systemic risk. If the securities lost value, Citigroup would suffer losses funded by depositors' money. This was exactly the scenario Glass-Steagall had prevented for 66 years. Other universal banks copied Citigroup's model. J.P. Morgan Chase, Bank of America, Wachovia, all were using commercial deposits to fund securities trading. By 2006, the 10 largest American banks had over $5 trillion in securities investments funded by commercial deposits. Investment banks, meanwhile, were using their new access to commercial banking operations to leverage themselves to previously impossible levels. Bear Stearns, an investment bank that had remained independent rather than merging with a commercial bank, couldn't access insured deposits. They had to fund operations through short-term borrowing in capital markets. This limited their leverage to about $15 in assets for every $1 in equity capital. But universal banks like Citigroup could fund operations with deposits that were stable, insured, and essentially free. They paid depositors maybe 2 to 3% interest. This cheaper, more stable funding allowed them to leverage 30.1 or even 40.1. Higher leverage meant higher potential profits, but also higher potential losses. A 3% decline in asset values would wipe out equity completely at 30.1 leverage, and bank asset values were overwhelmingly composed of mortgage-related securities whose prices were all correlated. Some regulators noticed this risk concentration. In 2005, the FDIC warned that universal banks were becoming dangerously exposed to housing market declines. They recommended limiting mortgage-related securities to 10% of bank assets. The recommendation was ignored. The Office of the Comptroller of the Currency, the agency that had helped erode Glass-Steagall in the 1980s, overruled the FDIC. They argued that banks' risk management models showed mortgage securities were safe. The risk management models were garbage. They assumed housing prices would never decline nationally. Since that had never happened in modern American history, the models treated it as impossible. Therefore, mortgage securities were modeled as essentially risk-free. This was insane. Housing prices had declined nationally in the 1930s, during the depression that Glass-Steagall was designed to address. But bank risk managers treated the depression as irrelevant ancient history rather than a warning. The models also assumed that different mortgage-backed securities were uncorrelated. If one pool of mortgages defaulted, others wouldn't necessarily default too. This assumption was based on nothing. All mortgage securities were exposed to the same underlying risk: housing prices. When housing prices fell, all mortgage securities would fall together. But the models didn't account for this because it hadn't happened recently. Banks were making trillion-dollar bets based on models that ignored the most catastrophic scenario. Some bank employees tried to warn management. In 2006, several JP Morgan Chase risk managers sent a memo to senior executives warning that the bank's mortgage securities were overvalued and vulnerable to housing price declines. Management's response? They fired the risk managers for not being team players and replaced them with people who wouldn't question the strategy. Similar purges happened at Citigroup, Bank of America, and Wachovia. Risk managers who identified problems were removed. They were replaced by executives who'd tell management what they wanted to hear. Everything is fine. Profits will continue. We're well positioned for the future. This organizational corruption was enabled by Glass-Steagall repeal. When commercial and investment banking were separate, commercial banks had conservative cultures that valued risk management. Investment banks had aggressive cultures that valued profits. When they merged, the aggressive culture won. Executives from investment banking backgrounds dominated leadership. They brought investment banking values: maximize short-term profits, ignore long-term risks, pay massive bonuses based on current year performance. The numbers from this era are staggering. Between 2000 and 2007, bank leverage increased from 12.1 average to 30.1. Mortgage-backed securities outstanding increased from $1 trillion to $7 trillion. Subprime mortgages increased from 5% of originations to 20%. Bank exposure to housing-related assets increased from 15% to over 50%. And all of this was funded by FDIC-insured deposits. Taxpayers were unknowingly guaranteeing the riskiest financial speculation in American history. By 2007, the 10 largest American banks held $12 trillion in total assets, $8 trillion funded by deposits, $6 trillion in mortgage-related securities, average leverage of 28.1. If housing prices fell even 10%, these banks would be insolvent, and housing prices were about to fall 30%. The first cracks appeared in February 2007, when HSBC announced $10.5 billion in losses on subprime mortgages. HSBC was a British bank that had purchased a subprime lender called Household Finance in 2003. Household had originated billions in subprime loans, mortgages to borrowers with poor credit, low income, or no documentation. These loans were bundled into securities and sold to investors worldwide. In early 2007, those borrowers started defaulting. Housing prices had stopped rising. Adjustable rate mortgages were resetting to higher interest rates. Borrowers who'd been making payments based on low initial teaser rates suddenly faced payments double or triple their original amounts. They couldn't pay. Millions of homeowners fell behind on mortgage payments simultaneously. Foreclosures spiked, and the securities backed by these mortgages, which banks owned by the trillions, became toxic. HSBC's $10.5 billion loss was just the beginning. In April 2007, New Century Financial, one of America's largest subprime lenders, filed for bankruptcy. They'd originated $60 billion in subprime loans between 2004 and 2006, then sold those loans to Wall Street banks, who'd packaged them into securities. When the loans started defaulting, nobody wanted to buy the securities anymore. New Century couldn't sell their loan inventory. They ran out of cash, bankruptcy. Wall Street banks held hundreds of billions in securities backed by New Century loans. Those securities were suddenly worth far less than banks had paid, but the losses weren't being recognized yet. Banks were using accounting tricks to avoid acknowledging reality. In June 2007, two Bear Stearns hedge funds that invested in mortgage securities collapsed. They'd been leveraged $10 billion in mortgage securities, funded by $1 billion in equity. When the securities lost 15% of their value, the equity was wiped out. Bear Stearns tried to hide the losses. They moved the bad securities into internal accounts where they wouldn't have to mark them to market prices. But creditors demanded their money back. Bear Stearns had to admit the funds were worthless. The hedge fund collapse revealed something terrifying. Mortgage-backed securities that had been rated AAA, supposedly as safe as treasury bonds, were actually junk. Rating agencies had given top ratings to securities backed by subprime loans to borrowers who'd lied about their income. How had this happened? Because banks paid rating agencies for the ratings. Moody's, Standard & Poor's, and Fitch, the three major rating agencies, earned fees from banks for rating securities. If they gave tough ratings, banks would take their business elsewhere. So rating agencies gave everyone AAA ratings to keep the fees flowing. This conflict of interest had been illegal under Glass-Steagall era regulations. Rating agencies were supposed to be independent. But after Glass-Steagall repeal and subsequent deregulation, banks could pay for ratings directly. By summer 2007, it was clear that trillions in mortgage securities were overvalued, but banks weren't admitting their losses. They were hoping housing prices would recover, loan defaults would decline, and the problem would go away. The problem got worse. In August 2007, BNP Paribas, a French bank, froze 3 investment funds because they couldn't value mortgage securities anymore. Nobody was buying or selling these securities, so there were no market prices. Without market prices, the securities had to be valued using models. The model said the securities were worth close to face value. Reality said they were worth 30–50% less. The gap between model valuations and market reality was trillions of dollars. This valuation crisis spread panic. If banks couldn't value their assets, how did anyone know if they were solvent? Suddenly, banks stopped trusting each other. Interbank lending, where banks loan money to each other overnight, froze. Every bank worried that every other bank might be secretly insolvent. The Federal Reserve responded by injecting liquidity, lending money to banks that couldn't borrow from each other. On August 9–10, 2007, the Fed loaned over $60 billion to banks. This was unprecedented peacetime intervention. But liquidity wasn't the problem. Solvency was the problem. Banks had made bad investments that were now worthless. Lending them more money just delayed the day of reckoning. By September 2007, banks started announcing losses. Citigroup reported $5 billion in mortgage-related write-downs. Merrill Lynch reported $8 billion. Morgan Stanley reported $3.7 billion. These were just the losses they admitted. Reality was far worse. Bank stocks crashed. Citigroup fell from $55 per share in May 2007 to $30 by November. Bank of America dropped from $53 to $38. Bear Stearns collapsed from $170 to $90. Investors were realizing that Glass-Steagall repeal had created institutions that were far riskier than anyone had acknowledged. Commercial banks that should have been boring deposit takers had become leveraged hedge funds. When their bets failed, depositors' money was at risk. In October 2007, Merrill Lynch CEO Stan O'Neill was forced to resign after announcing $8 billion in losses, later revised to $15 billion. He'd presided over the transformation of Merrill from a conservative investment bank into a subprime mortgage speculation machine. O'Neill received a $160 million severance package. He walked away rich while Merrill's shareholders and employees suffered catastrophic losses. This pattern repeated across Wall Street. Executives who'd made the decisions that destroyed their banks collected hundreds of millions in compensation and walked away. Employees, shareholders, and eventually taxpayers bore the losses. By December 2007, the financial crisis was undeniable. Banks had lost over $100 billion in the previous 6 months. More losses were coming. The entire financial system was unstable, but the worst was yet to come. Because in March 2008, Bear Stearns would become the first major investment bank to collapse, and 6 months later, Lehman Brothers would file the largest bankruptcy in American history. The catastrophe Glass-Steagall had prevented for 66 years was about to explode. March 14, 2008, Bear Stearns had $17 billion in cash at 9 a.m. By 5 p.m., they had $15 billion disappeared in 8 hours. Not through bad investments, through a classic bank run. Bear Stearns' creditors simultaneously demanded their money back. Bear couldn't raise cash fast enough. They were finished. How did this happen to an investment bank that had survived 85 years, including the Great Depression? Bear Stearns had funded their operations with short-term borrowing, overnight loans from other banks and money market funds. Every day they'd borrow tens of billions to fund their securities positions, planning to repay it the next day and borrow again. This funding model worked as long as creditors trusted Bear Stearns. When trust disappeared, the model collapsed instantly. Creditors refused to roll over Bear's overnight borrowing. Without funding, Bear couldn't operate. The Federal Reserve orchestrated an emergency rescue. They facilitated J.P. Morgan Chase's acquisition of Bear Stearns for $2 per share, down from $170 a year earlier. J.P. Morgan wouldn't have bought Bear without government support. The Fed agreed to guarantee up to $29 billion of Bear's worst mortgage securities. This was an unprecedented intervention. The Federal Reserve doesn't normally rescue investment banks. But Bear Stearns was so interconnected with other financial institutions that their bankruptcy would have triggered a cascade of failures. The rescue was also illegal under traditional Fed authority. But Fed Chairman Ben Bernanke invoked emergency powers dating to the Great Depression, powers that hadn't been used since the 1930s. Glass-Steagall had made these powers unnecessary for 70 years. Now they were desperately needed. Bear Stearns' collapse should have been a wake-up call. If a major investment bank could fail overnight, others were at risk. But Wall Street and regulators convinced themselves Bear was unique, poorly managed, overly exposed to subprime mortgages. Other banks were supposedly safer. They were wrong. Every major bank had similar exposures, leverage, and funding vulnerabilities. Bear Stearns wasn't uniquely bad, they were just first. Between March and September 2008, financial conditions deteriorated steadily. Banks announced larger losses each quarter. Credit markets froze. The economy slipped into recession, but no other major institution failed. Then September 2008 arrived. September 7th. The Treasury Department seized Fannie Mae and Freddie Mac, government-sponsored entities that guaranteed trillions in mortgages. They were both insolvent, with losses exceeding $100 billion. Taxpayers would eventually pay $190 billion to bail them out. September 14th. Merrill Lynch, facing bankruptcy, sold itself to Bank of America for $50 billion, half its value a year earlier. Bank of America would discover Merrill's losses were far worse than disclosed and would need $45 billion in government bailouts to survive the acquisition. September 15th. Lehman Brothers filed for bankruptcy. With $639 billion in assets, it was the largest bankruptcy in American history. The government refused to rescue Lehman, believing the market could absorb the failure. They were catastrophically wrong. Lehman's bankruptcy triggered panic. Every financial institution that had loaned money to Lehman faced losses. Every company that used Lehman for trading or financing was suddenly without a banking partner. The entire financial system seized up. Money market funds, which ordinary Americans used as safe, liquid savings accounts, began failing because they held Lehman debt. Reserve Primary Fund, a $62 billion money market fund, broke the buck. Its share value fell below $1 because of Lehman losses. This triggered runs on money market funds across America. Investors withdrew $300 billion in 3 days. Money market funds had to sell assets in fire sales to raise cash. The commercial paper market, where corporations borrow for daily operations, completely froze. Within 72 hours of Lehman's bankruptcy, the entire financial system was collapsing. Companies couldn't make payroll because they couldn't borrow. Banks couldn't lend because they didn't trust any borrower. Credit markets simply stopped functioning. September 16th, AIG, an insurance company that had written $440 billion in credit default swaps insuring mortgage securities, was hours from bankruptcy. The Federal Reserve provided an $85 billion emergency loan to keep them operating. AIG's problem was simple. They'd insured mortgage securities against default. When mortgages defaulted, AIG owed billions to counterparties. But AIG didn't have the money. They were an insurance company that had written insurance they couldn't afford to pay. And AIG's counterparties were every major bank on Wall Street. If AIG failed, it would trigger cascading failures across the financial system. Goldman Sachs alone had $20 billion in exposure to AIG. If AIG went bankrupt, Goldman might follow. The Fed's $85 billion loan was the first installment. AIG would eventually receive $182 billion in government support, the largest bailout in American history. September 21st, Goldman Sachs and Morgan Stanley, the last two major independent investment banks, converted to bank holding companies. This gave them access to Federal Reserve emergency lending and FDIC deposit insurance. It also subjected them to commercial bank regulations they'd previously avoided. The conversion marked the end of investment banking as a separate industry. Glass-Steagall had kept commercial and investment banking separate for 66 years. That separation had been dead since 1999, but a few pure investment banks remained. Now, they were gone. September 25th, Washington Mutual, a savings bank with $307 billion in assets, was seized by the FDIC after a bank run. It was the largest bank failure in American history. JP Morgan Chase acquired WaMu's assets for $1.9 billion. WaMu had transformed from a boring savings bank into a subprime mortgage machine after Glass-Steagall repeal. They'd originated billions in subprime loans, selling them as securities to investors. When the mortgages defaulted, WaMu couldn't survive. September 29th. Wachovia Bank, America's fourth largest bank with $812 billion in assets, was on the verge of collapse. They'd acquired Golden West Financial, a subprime lender, in 2006. Golden West's mortgages were now defaulting catastrophically. Citigroup initially agreed to acquire Wachovia in a government-brokered deal, but Wells Fargo swooped in with a higher offer. After a bidding war, Wells Fargo bought Wachovia for $15 billion, a fraction of its previous value. October 3rd, Congress passed the Troubled Asset Relief Program, TARP, a $700 billion fund to bail out failing banks. The bill passed only after the stock market lost $1.2 trillion in value in one day, convincing reluctant congressmen that failure to act would cause complete economic collapse. TARP was supposed to buy bad mortgage securities from banks. Instead, Treasury Secretary Hank Paulson, former Goldman Sachs CEO, decided to inject capital directly into banks. The government would buy preferred shares, essentially nationalizing parts of the banking system. The 9 largest banks were required to accept capital injections, whether they wanted them or not. This was to prevent markets from identifying which banks were truly desperate. JP Morgan received $25 billion. Citigroup received $25 billion. Bank of America received $25 billion. Wells Fargo received $25 billion. Goldman Sachs received $10 billion, but even $700 billion wasn't enough. Citigroup needed additional rescues. In November 2008, the government injected another $20 billion into Citigroup and guaranteed $306 billion of their worst assets. In January 2009, they provided another $150 billion in guarantees. Total government support for Citigroup exceeded $476 billion, more than any single institution has ever received. And this was the bank whose illegal merger had forced Glass-Steagall repeal. Bank of America needed similar support after acquiring Merrill Lynch. They received an additional $20 billion and $118 billion in asset guarantees. Total Bank of America support exceeded $160 billion. By March 2009, the government had committed $700 billion in TARP funds, $1.5 trillion in Federal Reserve emergency lending, $3.2 trillion in FDIC guarantees, $600 billion in Fannie, Freddie support. Total government exposure exceeded $6 trillion, nearly half of US GDP. The economic damage was catastrophic. 8.7 million jobs lost between 2008 and 2010. Unemployment reached 10% nationally, 15% in some states, 10 million foreclosures between 2007 and 2012. Household wealth declined $16 trillion. Stock market lost 50% of its value. Total economic cost estimated at $22 trillion. This was the worst economic crisis since the Great Depression, and it was entirely preventable. Glass-Steagall had prevented this exact scenario for 66 years. The law separated commercial banking from investment banking, so that when investment banks made bad bets, commercial deposits weren't at risk. When Glass-Steagall was repealed, banks combined these activities and used depositors' money to fund securities speculation. When the bets failed, taxpayers had to bail out the banks to protect depositors. The cost was trillions, and the banks that had lobbied hardest for Glass-Steagall repeal, Citigroup, Bank of America, needed the largest bailouts. Some people went to jail, right? No, not a single Wall Street executive was criminally prosecuted for the conduct that caused the crisis. The SEC brought some civil cases, but nobody faced criminal charges. Angelo Mozilo, CEO of Countrywide Financial, paid a $67.5 million fine without admitting wrongdoing. He'd earned over $400 million between 2000 and 2008 while running Countrywide into bankruptcy. Dick Fuld, Lehman Brothers CEO, was never charged. He'd earned $466 million between 2000 and 2007 while loading Lehman with toxic mortgages. Stan O'Neill, former Merrill Lynch CEO, walked away with $160 million. Chuck Prince, former Citigroup CEO, collected $140 million. James Kane, former Bear Stearns CEO, kept $289 million. The executives who destroyed the economy kept their fortunes. The American people paid trillions to clean up the mess, so we've seen how one law protected America for 66 years, then was destroyed by the industry it regulated. Glass-Steagall wasn't perfect. It didn't prevent all financial problems, but it prevented the specific catastrophe that occurred in 2008. Commercial banks using depositors' money to speculate in securities markets, then collapsing and requiring taxpayer bailouts. For 66 years, from 1933 to 1999, America didn't have a major banking crisis. Individual banks failed occasionally, but the system remained stable. Depositors never lost money in FDIC-insured accounts. The banking system never faced systemic collapse. Then Glass-Steagall was repealed. 9 years later, the financial system collapsed in the worst crisis since the Depression that Glass-Steagall had been designed to prevent. The pattern is undeniable. Glass-Steagall worked. Its repeal failed catastrophically. And the people who promised repeal would make banking safer, Robert Rubin, Alan Greenspan, Larry Summers, were completely wrong. What's infuriating is that these people never admitted error. Greenspan gave half-hearted congressional testimony in 2008, acknowledging a flaw in his worldview. Rubin claimed he couldn't have known the consequences of repeal. Summers argued the crisis was caused by other factors. None of them took responsibility. None returned the fortunes they'd earned. Rubin made $126 million at Citigroup after leaving Treasury. Greenspan collected millions in speaking fees. Summers became a wealthy consultant. They all profited from the disaster they'd created. The real lesson here isn't about financial regulation, it's about regulatory capture. Glass-Steagall was destroyed because Wall Street bought Congress, captured regulators, and convinced America that the guardrails preventing disaster were actually holding back prosperity. The $300 million lobbying campaign between 1998 and 1999 was the most expensive legislative campaign in American history because the stakes were enormous. Glass-Steagall prevented banks from gambling with depositors' money. Repealing it would unlock trillions in profit potential. Wall Street got what they paid for. Congress delivered repeal. Banks made spectacular profits between 2000 to 2007. Executives earned hundreds of millions in compensation, and when the bets failed, taxpayers covered the losses. This is the fundamental corruption of American democracy. Wealthy industries can buy legislation that serves their interests at public expense, and the public won't realize what happened until the disaster occurs, by which time the people responsible have already collected their fortunes. Since 2008, there's been endless debate about reimposing Glass-Steagall. Elizabeth Warren has proposed new legislation. Bernie Sanders championed it in his presidential campaigns. Various bills have been introduced in Congress. None have passed. The financial industry still spends hundreds of millions on lobbying. They still donate massively to political campaigns. They still fund think tanks and academic research arguing that Glass-Steagall would hurt the economy. And most Americans don't understand what Glass-Steagall was or why it mattered. The Depression is ancient history. The 2008 crisis is fading from memory. A new generation of bankers who never experienced catastrophic financial crisis are arguing that regulations are outdated and holding back innovation. It's the same pattern that destroyed Glass-Steagall originally. Success creates amnesia. Amnesia enables deregulation. Deregulation causes crisis. Crisis creates new regulations. Then the cycle starts again. Whether we like it or not, financial crises are a recurring feature of capitalism, unless prevented by strong regulation. Glass-Steagall was that regulation for 66 years. Its repeal allowed the crisis its authors had predicted. The question facing America now is whether we'll learn from history or repeat it. Will we reimpose separation between commercial and investment banking, or will we continue allowing banks to gamble with depositors' money until the next crisis? I don't have the answer, but I know what Glass-Steagall's authors would say. Separating commercial and investment banking isn't about limiting profits or preventing innovation. It's about protecting depositors from risks they didn't consent to and preventing taxpayers from subsidizing Wall Street gambling. That principle was correct in 1933. It remained correct in 1999, and it's still correct today.